So hi everyone, welcome back, and today we are going to start a new chapter, that's International Financial Management. This is going to be an 11th chapter for us. Since we have already completed the Forex chapter, a lot of things from the Forex chapters will be used by us in this chapter. This chapter is pretty small in number of questions, that it has only 18 questions that we are going to look forward to. But last questions of this chapter are pretty big. So one advice that I want to give you before starting this chapter is that if the question comes from this chapter in exam, then keep or solve those questions at the end of your paper. Do not mess yourself with the questions of international financial management in the beginning or in the middle of the exam paper. Do not waste your time, because if the answers are big and if the questions are asked for 8 to 10 marks, then you will end up spending more time comparatively as compared to the other questions. So and one more thing that I have felt, my analysis and the past record says that even if you will end up making a small mistake, the rest of the answer will be wrong and you won't get marks. So just imagine spending 45 minutes to solve a question of 10 marks and then ending up getting no marks. So don't mess yourself with the big questions like this in the beginning. So if you have time and if you really want to solve it, keep it for the end of the paper. That's my suggestion. Okay, sir. International financial management, on and around 8 to 10 marks of question can be asked from this chapter. There can be a theory question also for 4 marks. There can be a practical question, a small question for 8 marks, and there can be a big question for 10 to 12 marks. Max to max 10 to 12 marks. That 12 marks is the maximum I am saying. But on an average, we can say around 8 to 10 marks of the question is expected to be asked from this chapter. Okay, couple of concepts are there in this chapter, like ADR, GDR, American Depository Receipt, Global Depository Receipt, nominal rate, real rate, inflation rate, and then we have geared ungeared beta as well, net present value, modified internal rate of return. So 4 or 5 concepts are there, and though all of them are pretty easy to understand, most of the time we will be solving the questions and we will be understanding the process of solving those questions. Okay, so let's first come to the concept sheet. We will have a look on the concept sheet, like what type of questions we are going to solve. See, you can clearly see that the first 2 questions are of global depository receipt. We are going to take the first one and I will keep the second one for your homework. Then foreign company investing in India issuing equity shares for expansion, then foreign currency approach, home currency approach. Okay, then we can see we have some Indian company investing in foreign country, foreign company investing in India. That is what is going on. And most of the questions will be calculating net present value. So you can see from the very beginning, like 10th question to 18th question, in all the questions we will be calculating or focusing most of the time on calculating net present value. So this is a big concept that was covered in your CA intermediate in financial management. Net present value, we'll look for that concept also in this lecture. Okay, sir. So to start with, let's start the first thing as the global depository and American depository receipt. This is a very easy concept to understand and you need to focus on this. Okay, let's start from the requirement that an Indian company, okay, so this is India, this is a company in India, an Indian company needs to raise funds. If Indian company needs to raise funds, they have a lot of option in India itself, like they can issue equity share, they can take the loan from the bank, they can issue preference shares also, they can issue debentures also. So there are lots of long-term sources of funds in India itself. But a lot of time when you this happens that you want to issue funds from the international market. So in that case, if you directly want to issue from other country, you will have to convert your equity shares into receipts. So let's say, for example, I'm just giving you an example that this Indian company deposits their equity share and that's worth of 10 crore. Just a figure. So they deposit their equity shares with a custodian bank in America. Okay, so They will deposit their shares with the custodian bank, and now the custodian bank will bundle those shares in a document. In a document, let's say for example, one document is equal to 5 shares. So basically, custodian bank is bundling 5 shares into one document, and now those documents will be listed on the stock exchange of America. Stock exchange of America, where a common US investor can come and buy those documents. So what will happen? We gave shares to the custodian bank converted them into a document, that those documents got listed on the stock exchange, and now the investors are buying those documents. When the investors will buy those documents in the initial public offer, that money will go to the custodian bank will keep their fees, and rest of the funds will be transferred to the Indian company. So this is how Indian company is raising funds from the international market. One thing you should understand, that directly US investors directly cannot buy the shares of this company. So that's why what they are doing is they are buying this document in their own market, in their own country. Now this document that I'm talking about is called as American Depository Receipt. ADR, American Depository Receipt, which represent how many shares are held by one document. In this case, 5 shares. So by bundling 5 shares and issuing that document to the US investors, this company can raise funds from other country as well. So if we are doing this in America, then these receipts will be called as American Depository Receipt. And if we are doing somewhere in other country, if we are following the same procedure in other country, if we want to raise funds from other country, those will be called as Global Depository Receipt. Global Depository Receipt. So what will happen, I will tell you. Whenever the company will declare dividend, the entire dividend will go to this custodian bank, and then custodian bank will accordingly issue dividend to these investors according to the documents they are carrying. So let's say for example, the dividend is 4 rupees per share. So in India, every share will be credited with 4 rupees of the dividend, but in this case every document will be credited with 4 into 5, 20 rupees of the dividend, because one document carries 5 shares and one share is like for 4 rupees. Also it is in rupees, but in America it will be converted, that 20 rupees will be converted into dollar, and then it will be issued to the US investors. Now this is how the things will happen. More of it will be looked after by us in the question number 1. So more or less we can say, converting the equity share into a document or another document and issuing that document on the stock exchange so that normal people can buy it, called as the American Depository Receipt. If it is issued in America, it will be called as Global Depository Receipt if it is issued outside America. Okay, do you understand this concept? Let's have a look on the first question now. See, pretty good question. Wright Limited has proposed to expand its operations, for which it requires fund of $30 million net of issue expenses. Obviously, there will be some issue expenses. I told you, just like custodian bank will keep their fees because they are not going to work for free, right? So they will keep their fees and then they will transfer the money to us. So if investors are paying 100 rupees to the customers, the custodian bank, then custodian bank will pay us only 96 rupees and 4 rupees will be kept by them as their fees. That will be called as issue expenses. Okay, sir. Now, so this company needs $30 million net of issue expenses. That means after paying all the issue expenses, the balance that will be credited to our bank account or that will be received by us should be 30 million. What does that mean? It means that we have to issue or we have to raise more than 30 million funds from the market, so that after deducting the expenses, what comes in our hand should be 30 million. Acha, what is the issue expenses? Issue expenses are 4% of the issue size. It's 4% of the issue size. Now, how to calculate that? It's very simple. If the 4% will be deducted by the custodian bank, 96% will be transferred to us, and we want that 96% to be $30 million. So, with that, we can calculate, with these details, we can calculate in total how many, or what should be the amount of issue, what should be the size of the issue. It's very simple. If 30 million is 96%, then 31.25% should be the total issue size. So in case 31.25 is issued from the market, 1.25 will be kept as an issue expenses and 30 will be transferred to us. Okay. It is proposed to raise the funds through a GDR issue. It considers the following factor in pricing the issue. See. So basically, let me take this as India and this as any other country. Country X. Okay. So we want to issue around 31.25 million. Out of that, 1.25 will be the issue expenses. 30 million will be the net of issue expenses. Okay. All these are in dollars and in millions. Now, the expected domestic market price of the share is 300 rupees. See. Now, what is the market price of the share? Market price is 300 rupees per share. So it is in rupees, that's why I am writing it in Indian column. Face value 10 rupees each share. 4 shares will underlie each GDR. Understand? 4 shares will underline one GDR. Okay. Now, so what should be the value of one GDR in terms of rupees? It should be 1200 rupees. Okay, sir. Now, underlying shares are priced at 20% discount to the market price. So whatever the market price will be, we will discount it by 20%. That means the GDRs will be 20% lesser priced, or GDRs will be issued at a 20% discount. So what will be the total amount? And the GDR will have to be issued in terms of dollar, not in terms of rupees. Okay. What else? Expected exchange rate is 70 rupees per dollar. So we can convert that with this exchange rate. You are required to compute the number of GDRs to be issued and cost of the GDR to write limited. See, it's very simple. First of all, number of GDR. How to calculate? It's very simple. Total issue size divided by price of each GDR. At what price we are issuing each GDR. Total issue size is 31.25 million. Do you agree with this? Also, price of each GDR. Now this is an interesting part. Understand, one share is worth 300 rupees, and in total 4 shares will be included in one GDR. Okay, so the total value comes to 1200 rupees, and it will be issued at a discount of 20%. Let me just do this calculation here. One share into 300, and in one GDR there will be 4 shares, and this entire price, or it's better to write it like this: one share 300, total one share is worth 300 into 4, that means 1200 less 20% discount, that means 960 rupees. So all these are in rupees. Okay, but the GDR has to be issued in terms of dollar. So this 960 rupees is the net issue price. Understand, 960 rupees is the net total issue price, which has, but it is in rupees. We have to convert that into dollar with the exchange rate given in the question, which is 70. So 960 by 70 comes to 13.71. So 13.71 will be the price of 1 GDR. So this is in dollar, this is in dollar, 13.71. Have a look. Do you agree with this? 2.279358. That is 22,79,358 GDRs has to be issued in the market. 2.279358 million GDR has to be issued. And it's very simple. The total amount that we want to raise is 31.25. Okay. And 1 GDR will include 4 shares. That means in terms of rupees, it cost us 1200 rupees. It has to be issued at a discount of 20%. So the net price should be 960, which is when converted with the exchange rate gives you 13.71. So every investor who wants to buy 1 GDR will have to pay $13.71. And this includes the issue expenses of 4%. This will be deducted later on. Okay. So this is the number of GDR. Okay. Now what will happen? The second part that let's just confirm once. So 31.25, 13.71, 2.2794 million. Do you agree with this? How to calculate the number of GDR? The total issue size divided by the price of 1 GDR. Okay. Now the second part of this question. You are required to compute the number of GDR to be issued and cost of GDR to write limited. So how much it is costing us, and how to calculate that if 20% dividend is expected to be paid with a growth rate of 20%. Okay. Cost of GDR is nothing but the KGDR. It is as good as calculating cost of equity. Cost of equity. And how did you calculate the cost of equity in the chapter security valuation? It's very simple, sir. Market price of a share is equal to, understand, market price of a share is equal to dividend D1 divided by cost of equity minus growth. And in this case, it will be market price of the GDR is equal to D1 divided by cost of GDR minus growth. Okay. Now, what is the market price of the GDR? You can calculate that in terms of rupees, because we need to calculate the cost for Right Limited, which is sitting in India, which is from India. So what will happen? I will tell you. 960 rupees will be, or $13.71 will be collected from the investor. It will be then converted to rupees, which will be 960. But understand, 4% out of it will be kept as an issue expenses. So we will not receive the entire 960. We will receive 4% less. 4% less. And that is what we are going to take under consideration as a market price, because the cost that we are going to calculate is on the amount that we will be using, and the amount that we'll be using will be 4% lesser than what the investor has paid. 4% is what the company or the custodian bank is keeping with them. So that is the trick here that you need to understand. Market price doesn't mean 13.71. It should be 13.71 less 4%. Okay, so in another sense, I can write it like this. Understand, 13.71 less 4% issue expenses. This is called as issue cost, and then multiplied by 70 in order to convert them into exchange, in order to convert them into rupees. Okay, so this will be 13.71 less 4% into 70. That comes to 921. Or 960 less 4%, 921.6, right? 960 into 0.80, 768, 4%, 960 into 0.96, yeah. So 921.60 in terms of rupees, it is like this. This is what you are going to receive in your hand. in terms of rupees. I will just show you. And dividend, let's say what is the amount of dividend? It's 20% dividend on the face value of 10 comes to 2, and 1 GDR includes 4 shares, that means 2 into 4, 8, and it is expected to be paid, that means it is D1. Okay, so 8 divided by cost of GDR has to be calculated minus 0.20. Am I right? Now let's calculate. Cost of GDR is equal to 8 divided by 921.60 plus 0.20. So that's around 20.89%. Let's calculate. 20.87. It's very simple. See, cost of equity, it should be cost of GDR instead. It's not equity. Okay. 8 is nothing but 20% of 10, which is the face value, 2 rupees per share into 4 shares in 1 GDR. So on 1 GDR you will be paying dividend of rupees 8. Obviously you will be paying in terms of dollar, but we are calculating in terms of rupees because we want to calculate the cost to us. Whatever the dividend cost is, it is in terms of rupees 8 for us. And 921.60 is the market price or the issue price minus issue cost. So this is the issue price minus issue cost, the net that is received by us. So what is happening? We are paying 8 rupees as a dividend on the for using this much of the amount at a growth of 20%. So it is costing us 20.87%. Every rupee from GDR issue is costing us 20.87. That means if we have raised 100 rupees from GDR, we will be paying 20 rupees 87 paisa as a cost or interest or dividend on that amount. So that's called as the cost of the GDR to Write Limited. Okay, couple of things. This is an Indian company. Okay, this is a custodian bank, and these are the US investors. So try to understand the procedure. The very first thing is we need 30 million and they want to keep 4%. So what will they have to do is they have to raise around 31.25 million. Out of that, 1.25 million will be kept by the custodian bank and 30 million will be given to us. Okay, so this is in total, but when we talk about per share, it will be like yeah, so we have 300 price for 1 share and we want to include 4 shares in 1 GDR. So in terms of rupees it will be 1200 and we want to issue it at 80% price only. So 1200 into 80%, that's 960, and that is in rupees. When converted with 70, it will be around 13.71. So what will happen? Just have a look. These investors will pay around $13.71 for each GDR. Out of that, 0.55 let me write down, $0.55 will be kept by the custodian bank and 13.17 $13.16. Am I right? Yes. And $13.16 will be given back by the custodian bank to the company. So that 13.17 dollar when converted to Indian rupee will give you 921.60 in rounding off. So that is what you are using by issuing the GDR, and how much you are paying in terms of dividend, 8 rupees with 20% growth. So 8 rupees on this will give you the capital appreciation, will give you actually the dividend cost, dividend yield, and this is the capital appreciation. So this is dividend yield and this is capital appreciation. Total will be something like 20.87%. This is 20.87%. This is how it is going to cost us. It's an easy question. I just repeated it so that you can understand. Keep this as an homework. Now let's take this question number 3. This is very easy, so we can solve it quickly. A USA-based company is planning to set up a software development unit in India. Okay, and software developed at the Indian unit will be bought back by the US parent. So what will happen? The US parent company is setting up a separate entity in India, and they will transfer some funds. Okay, so US and Indian entity will do some work for a year, and the entire plant, or we can say entire software, will be sold back to the US parent company. Okay, so US parent company will buy back this at a transfer price of 10 million US dollars. The unit will remain in existence in India for 1 year. The software is expected to get developed within this time frame. So please understand what the company is doing. American companies coming to India, set up a unit and then hire some engineers, and they will start working on this software development. For the entire 1 year, all the cost will be borne by this unit, for which the amount will be paid by the parent company. Once the software is developed, this entire unit will be closed, all the employees will be fired, they will be asked to go home, and this entire software will be sold back to the US company. Okay. Now, the US based company will be subject to corporate tax rate of 30% and withholding tax of 10% in India, and will not be eligible for tax credit in US. So there is no tax credit in US for this. The software developed will be sold in the US market for $12 million. So they will buy it back from India at $10 million, and they will sell it in the US market at $12 million, making $2 million as a profit. The other estimates are as follows. For the entire year, there will be some expenses like rent, okay, manpower and administration. All of these are costing us like this: 15 lakh rupees per year. Manpower is 80 professionals will be involved, 10 hours each day, 400 per man hour. So calculation will go like this: 400 per man hour, total 10 hours a day into 80 hours, 80 employees. Okay, and this is going to go for 30 days, or we can say 365 days. So this is just 1 day, na? 10 hours means 1 day. 80 employees working 10 hours a day multiplied by 365 is the total hours in an annum, per annum, and then 400 rupees per hour. So this is going to be the total manpower cost to you. Administrative cost is 12 lakh rupees. Advise the US company on the financial viability of the project. The rupee dollar rate is 48 rupees per dollar. See, I will tell you one thing. It is financially viable because you are going to buy the project at $10 million and sell it in the US market at $12 million. So feasibility is not an issue. The issue is what is the total cost of development. This is the selling price or buying price, we can say. But what is the total cost of development? These three includes the total cost of development, right? Apart from the taxes as well. So let's first consider step by step total selling price. We have to pay the taxes on the profit. So we need to know the sales and the purchases and the expenses as well. So sales will be 10 million US dollar because the parent company will buy back, but the Indian unit will sell it to the parent company, na? So Indian unit will have to pay the tax on the sales of $10 million. So that 10 million when multiplied with the 48 rupees per dollar will get 48 crore rupees. So this is going to be the revenue for Indian unit, 48 crore rupees. It will be calculated like 10 million into 48. So this is revenue, and out of this revenue, all the expenses will be borne by the unit. So this is the rent, 400 man hour or 400 rupees per hour into 80 employees. So this is the cost of 80 employees per hour. This is the cost of 80 employees per day, and this is the cost of 80 employees per annum. 11 crore 68 lakhs. Okay, after that administrative and other cost, all these three will add to 11 crore 95 lakh as the cost. And you can imagine this is the only cost. 48 crore is the revenue, 1195 is the cost. This is earning before tax, 36 crore. Out of that, the tax of 30% will be paid. Okay, the balance left earning after tax can be transferred back to America. Why? It's very simple, sir, because the unit today, the unit present is of American company itself. So whatever will be left in this company, Indian company, will be repatriated. Repatriation means will be transferred back to the US company. But there is one more tax applicable, withholding tax. On whatever payment you transfer from India to the other country, you have to pay the withholding tax of 10%. So while making this transfer, you will have to pay again a tax of 10%. You might argue on this that we have already paid the taxes, then why there is a need to pay additional tax? And in this case, your argument can be right, because institute has three different answer to this treatment in this question. So first of all, let's assume this is 30% and this 10% is the additional tax you have to pay over and above 30%. Then this treatment is totally right. Whatever you will be transferring to your parent company, you will have to pay the tax on that. And then the balance amount can be called as a repatriation amount, which you can transfer to America. Obviously, it will be in rupees. When you divide it by 48, it will give you 4.7 million. Now understand, from the US parent point of view, they transferred $10 million to India and they are taking back around 4.7 million. So can I say for the US company, the balance out of this, that is 5.3, will be the total cost of development of the software? Yes, sir. And this total cost includes rent, manpower. I will just mark it. This 5.3 includes rent, manpower, administrative, tax and TDS. The normal corporate tax and the TDS also becomes a part of the expense for the US company. And they are not going to get the credit of the same in US. So $5.3 million is the total expense out of 10, and the balance 4.7 can be transferred to the parent company. Have a look. The cost of development of the software in India for US based companies 5.268 million. That's 5.3 million. As the USA based company is expected to sell the software at $12 million, it is advised to develop the software in India. That means you can take this decision. I was already ready with the decision because we are buying at $10 million and selling in the US market at $12 million. So $2 million is absolute a profit. Apart from that, this 4.7 is also an additional profit repatriated. Okay. What the entire story is like, we have given $10 million to the Indian unit and you can do anything out of this. You can incur entire amount as an expense also if you want to. But we couldn't expense out the entire amount. So the balance amount left is transferred back to the parent company, $4.7 million. Okay, sir. The another argument that can be made is, if it is assumed that since foreign subsidiary has paid taxes, it will not pay withholding tax, then the solution will be as under. Withholding tax sometimes is considered as TDS. In India, it is considered as TDS. And TDS is a part of the total tax that we pay. If you remember, if you have gone through the direct tax subject, what happens is, if we have a total liability of 2 crore rupees as a tax, and if we have already paid the TDS of 0.50 crore, then the balance payable only becomes 1.5 crore, right? So if we have already paid 2 crore, then there is no need to pay TDS. That's what it is. That's what the rule is. So if we have already paid the entire 30%, then there is no sense of making the withholding taxes, that is called TDS. This 10% is deducted, but it is included in this total tax. So if we assume it like India, then you will just skip this process and the earnings after tax will become the repatriation amount. The earnings after tax will become the repatriation amount. See. So this earning after tax will become the repatriation amount, which can be converted back to the parent company, and in this case you can see the repatriation amount is higher and the total cost is lower. Obviously you have saved on the total cost of TDS. Another alternative that the institute has given is that if it is assumed that the withholding tax of 10% is being paid and then its credit is taken in the payment of corporate tax, then the solution will be as follows. This is exactly what happens in India. Let's say, for example, I am a chartered accountant and I am into practice and someone is paying fees to me. So when someone is paying fees to me of 1 lakh rupees, he will automatically deduct 10%, that is 10,000, and they will deposit it with the government. Okay, so this 10% is the withholding tax or TDS that has already been deducted. And at the time of filing the ITR, if 1 lakh rupees is my total profit only, what will happen? I will pay 30% tax on that, let's say, and that comes to 30,000 rupees. But the problem is, this is the liability and I have already paid 10% out of it, so I will only be paying 20,000 now. So 20% and 10% is the bifurcation. This is how practically it happens. Now in the third alternative, institute has given the answer exactly like what happens in India. So let's have a look. This is the withholding tax. 10% first you will pay withholding tax, that is TDS. And this is the earnings after withholding tax, and this is the corporation tax net of withholding tax. So whatever the 30% of this amount is, out of that you will just deduct 10% because you have already paid that amount, and the balance 20% will be paid now, and the repatriation amount will remain same as above, 25, 23, 50,000. It is just the presentation. In the second and the third alternative, the tax amount is same, which is 30%. That's it. Either you pay the entire 30% and do not pay the withholding tax, or like either you pay this way. This is the second way. I will tell you what has happened in all the three alternatives. The first answer shows that we are paying 30% and 10% both. The second alternative shows that we are paying only 30% and no TDS. And the third alternative shows that first we paid the TDS of 10% and then the balance 20% as a tax, 30 minus 10. So this is proper, the third alternative. In exam you should do this. Okay, sir. Question number 4 now. This is little, we can say, complicated to understand. Have a look. See. The directors of Implant Incorporation wish to make an equity issue to finance a 10 million expansion scheme which has an expected net present value of $2.2 million and to refinance an existing 6 million 15% bond due for maturity in 5 years time. So there are two things. Okay, understand. There is a company which wants to issue $10 million from the market. Okay, and this is for the expansion purpose, in which the investment, that means outflow and inflow, will consider the net present value, will give us the NPV of $2.2 million. That means this is the net profit. That's a good thing that the NPV is positive. And to refinance an existing 6 million 15% bond. That means refinance means what? We had already issued this bond years back and we are paying every year interest on that $6 million. And that is 15%, I think, due for maturity in 5 years time. And 5 years are still left for this bond. If we continue this bond, we will have to pay 15% every year on $6 million. That's an interest cost. For early redemption, and because we are repaying the bonds 5 years back, these bonds, there is a penalty charges of $350,000. So this is the cost of early redemption. The company has also obtained approval to suspend these preemptive rights and make a $15 million placement of shares, which will be at a price of $0.5 per share. That means this is how much we are going to issue, $15 million, out of which $10 million will be used in this expansion scheme, and like $6 million, 350.35 million will be used as a penalty. So you can consider that 10 plus 6, 16 is there, plus penalty charges are also there. We'll see to that. The flotation cost of issue will be 4% of the gross proceeds. Okay. Any surplus funds from the issue will be invested in Indian Depository Receipt, IDR, which is currently yielding 10% per year. The present capital structure is as follows. See, you can clearly see the capital structure right now. We have ordinary shares, $1 per share. Okay, $1 per share. So how many number of shares are there? Obviously 7 million shares are there. Every share is having a face value of $1. The premium is 10,500. Everything is in thousands. Free reserves, 15% term bonds. This is what we want to redeem. That we want to repay this right away itself. We want to save on the interest cost for the next 5 years. And if we redeem it today itself, we will save the redemption at the end of 6th year as well, or 5th year as well. This is the 11% debenture. Current share price is $2 per share and the debenture price is $103 per debenture. Cost of capital of the company is 10%. It may be further presumed that the stock market is semi-strong form efficient. What is this semi-strong form efficient? It means that the past information and the public information is already included in the share price, and no information about the proposed use of funds from the issue has been made available to the public. Right now we have not made we have not informed the public that why we are going to use these funds. We are going to use it for the expansion and the redemption of the debt. But this is not known to the public yet. You are required to calculate the expected share price of the company once full details of the placements and to which the finance is to be put are announced. Once you announce this detail, this is a private information. Remember, there are 3 things in the weak form or market efficiency: past information, public information, and a private information. Past and public information are already included in the share price, but this is the private information, that why we are going to use these funds, and this information is not made available to the public. Once this is made available to the public, it will become a public information and it will affect the share price, which is $2 at present. Okay. So what exactly you are expected to do is very simple. Calculate the total market value of the company. The current market value of the company is $2 into 7 million, that is 14 millions. Current market value of the company is $14 million. Now what are you going to do in this market value? You are going to add all those values which will increase the market value, or add all those figures which will, or we can say add all those transactions which will increase the market value of the company, deduct all those transactions which will decrease the market value of the company. Okay, one thing, first of all, you can see if we raise $15 million, just understand 15 million is coming into the company. That will increase the value of the company. So add $15 million first of all. But there will be some issue cost. So we can say 15 into 4%. This is the issue cost, $0.6 million. That will go out of the company. So that will reduce the value of the company. So this is covered, this is covered. Now, we will invest in the expansion program. Okay, and the investment, that means cash outflow and inflow, are not given to us. But please understand, the NPV is given to you. That means if the cash outflow is 10 million and the cash inflow is 12.2 million, the net NPV will be 2.2 million. So instead of deducting 10 and adding 12.2, because cash outflow is 10 million, cash inflow is 12.2 million, what are we going to do in this statement? We will deduct the cash outflows and add the cash inflows. That is what we were supposed to do. But instead of doing all these things, we can simply add 2.2 million. Add 2.2 million. Simply. That's why there is no need for the figures of cash outflows and cash inflow in the question. This is just imaginary figures that I have taken just to explain you that the net impact of these two will also be equal to 2.2. So I have added directly 2.2. So expansion. The market value of the company will increase by 2.2 million because due to expansion we are making a profit of 2.2 million, right? So to that extent the market value will increase again. Now we will refinance the existing bond. That means what will happen? We will repay $6 million to the existing bondholders. Okay, so that will go out of the company once we will repay. So that will reduce the value of the company. Again, there will be some penalty charges. So 0.35 will also be out of the company. That will also reduce the value of the company. So this is the total. But there is one more thing which is hidden that you might be skipping. Because of this repayment of the existing bond, understand there are 5 years left to the bond. Okay, because you are making a repayment or you are redeeming the $6 million bond, what will happen is you will save on the interest cost every year, which will be $90,000. 6 million into 15%, that's $9 lakh or $0.9 million. So every year you will be saving $0.9 million. Also you are saving an outflow of $6 million at the end of 5 years, because you have already made this in outflow or redemption here. You have saved the redemption here as well. Otherwise you would have to make the redemption at the end of 5 years, right? Now you don't have to make this redemption because you have already made it. So these are the savings that you need to consider. But these we cannot add exactly as it is. We need to calculate the present value of the same. So we have been given with some cost of capital which is 10%. What you have to do is you have to calculate the present value of all the 0.9 million saved every year and 6 millions at the end of 5th year. And these are because these are savings, we will add that. And then we are going to do the total of this, and then we will say that after adjustment of everything, this is the market value of the company. And the total number of shares are 7 million plus the new that has been issued, because we have raised $15 million at a price of 0.5 per share. That means 30 million more shares have been issued. The total number of share will be now $37 million, 37 millions. So the total market value divided by 37 million shares will give you the new market price. Do you understand that? Let me repeat it now. So there are two things that will happen after the issue. You will spend some money in expansion, okay? And you can take anything like cash inflow can be 12.2 minus 10 or 8.2 minus 6, anything which will give the NPV as 2.2. So because of this expansion, the market value of the company will increase. Now come over to this redemption of bond wala part. Today you will make the repayment of $6 million and also you will bear the cost of penalty. But because of this, you will save on the interest cost every year and you will also save on the redemption at the end of the 5 years. So these two are the private information. Once this is released, the market value will go up and down. Okay, now coming over to the valuation. What is the existing market value of the company? It's 7 million into 2, that is $14 million. Now, you are going to raise more funds which is worth $15 million, which will come into the company and increase the market value. That's 30 million shares issued at 0.50 per share. See, it is clearly written here. Now, so this will deduct flotation cost, which will be 0.6, which is simply 4% of the gross figure. In the first question, the 4% was the issue cost net of, right? Here it is gross. So we have directly applied it on 15 million. Now, add NPV of the expansion plan. Because of this expansion, our market value will increase. Less redemption of the bond and the penalty charges. But because of this redemption, we are going to save up on the interest cost for 5 years. That will be 6 million into 15%, and the present value annuity factor for 5 years with 10% comes to 3.791. If you remember, these are like 0.909, 0.826, 0.751, 0.683 and 0.621. So if you do the total of all the 5 factors, it will come to 3.791, and for the 5th year it is 0.621. So there will be two savings. $99 lakh of interest will be saved for the next 5 years because there are no bonds now in the balance sheet, and there is no need to pay 6 lakhs again at the end of 5 years. So the total saving comes to 71,37,900. That is around 7.13 or 14 million. So this will add up to the market value of the company because this is the outflow saved now. Simple. So what we have done is very simple, sir. All the transactions which will add to the market value have been added, which will deduct the market value, reduce the market value have been deducted. And then the revised market value comes to 31.38 million. Yes. And the total number of shares are 37 million. 7 million existing shares and 30 million new shares. The market price of the equity will come to 0.848. This divided by number of shares. Market price, total market value divided by number of shares. That's it. Question was easy, sir. It seems it is difficult, but it's direct. We are keeping the values. There are no further calculations required. And this is very important part because most of the students will manage to reach up to this point, but they will forget that what is the benefit of redemption. This is the benefit of redemption. You are saving upon this much of the cost for the next 5 years. And we have taken the present value of that. Okay. So this was question number 4, sir. See, 0.848. Total market value and total number of share. 0.848 is the new price of the share. So earlier it was $2 and now it is 0.848. Why? Because you have issued 30 million shares at 0.5. 7 million was on $2. Every share was of $2 and 30 million shares have been issued at just 0.5, and that's why everything has changed. Okay, sir. That's it. Question number 4 is over. We will take a break and I will be back in order to explain you what happens if we invest in other country, how to evaluate those projects. It will be all about the net present value. But there will be 2 approaches that we are going to learn: home currency invoicing and foreign currency invoicing. See you after the break. So welcome back everyone, and now we are going to start with the new concept. For question number 5 to 10 we are going to use these concepts. The concept's name is the home currency and foreign currency approach. Before starting this, let me clear one thing that like in CA intermediate financial management also you have learned this concept named as NPV, net present value. Now what used to happen in case of net present value? Whenever we have to decide that whether we should invest in a project or not, we used to calculate the net present value. That means present value of cash inflows minus present value of cash outflows. All the inflows should be calculated at present, outflows should be at present, and then you calculate the NPV, net of both inflows and outflows, is called as net present value. Okay. Whenever you calculate a net present value, then you decide whether the NPV is positive or negative. If the NPV is positive, we used to accept the project. If it is negative, we used to reject the project. Okay. In this case also, in the coming questions, we are going to calculate the NPV, but the main problem that will be there is we will be investing out of India, out of the country. So what will happen in that case is there will be a foreign currency cash flows. Now suppose we invest in America and every year the cash flows are generated in terms of dollars. Let's say like this, 1, 2, 3, 4, 5, and you are receiving cash inflows in terms of dollar. Now how to calculate NPV when the cash flows are given in case of foreign currency? So there are 2 different approaches to this. One is called as home currency approach and the another one is called as foreign currency approach. Have a look. So whenever you have to evaluate the project, you need to make sure which type of policy or approach you want to use. Okay. One can be home currency approach, the another can be foreign currency approach. And let me clear one thing. The answers from both the approaches will differ, will not be same. Okay. Now let's discuss from the home currency approach. Home currency approach means whatever the foreign currencies are there, you are going to convert all the foreign currencies like this. You are going to convert all the foreign currencies in terms of rupees at every year end. So you will take the year end forward rate, year 2 end forward rate, end of year 3 forward rate, end of year 4 forward rate, and 5. And then you are going to convert all the foreign currency cash flows into rupees. Okay, rupees means Indian currency. So this is how it will go. Year cash flows in foreign currency, you will take the exchange rate. You will take the exchange rate x x x x x. Okay, this is dollar 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 dollar, and then you are going to convert that in home currency. Once you have calculated all the cash flows in home currency, use the home country discount rate. Understand, the present value factor for calculating the present value of rupees should be home country discount rate. And then you can calculate the present value in terms of rupees. The total of that will also be in terms of rupees. But what will happen if you apply the foreign currency approach? In case of foreign currency, you directly discount these cash flows which are already in foreign currencies. Understand, this is 1, 2, 3, 4, 5, and then this is foreign currency cash flows. And since you have to discount the foreign currencies cash flows, you will take the foreign country discount rate in order to calculate the present value factor. Now this is one of the important difference in both the approaches. In home currency approach, you discount home currency with home country discount rate. In foreign currency approach, you discount foreign currency with the foreign country discount rate. Then you will calculate the present value that will again be in dollar. That means foreign currency. When you will do the total of all the present values, it will also be in dollar. And at the end, since this is a present value, you will take the spot rate to convert the dollar in terms of rupees. So ultimately, NPV will always be in rupees, like this and this. In both the approaches, you will ultimately calculate the net present value in your home currency. But the method to reach to this stage is different in both. Right? So once the NPV is calculated, decide whether it is positive or negative and accordingly accept or reject the project. This is so very easy. The main part is this, sir. In home currency approach, discount home currency. In foreign currency approach, discount foreign currency. And make sure that the discounting rate is of that country itself. It's very easy. We are going to solve some questions and then you will realize. But understand, foreign currency, discount foreign currency approach. Like foreign currency cash flows. Home currency approach, discount home currency cash flows. So this is one concept. Another concept that I want to discuss with you is nominal and real rate of return. Now, let's say this is a year and you have invested 100 rupees a year at the start of the year. And let's say, for example, the return is 10%, which is going to be 110. More precisely, I will write down 10 rupees of the return, 100 rupees of the principal, and total will be 110. Now, how much return that you have earned? Sir, you will say that you have earned 10% return. But in real sense, your return is not 10%, it is lesser than 10%. How, sir? It's very easy, sir. Now you are standing at the end of year 1 and in that entire year there is a concept called as inflation that has happened. Inflation eats up your return. Inflation eats up your return. Inflation reduces your purchasing power. So what happens is that due to inflation, the value of currency or the same 100 rupees is not worth 100 rupees today. That's what we want to say when we talk about inflation. Inflation eats up your return. Inflation eats up, or we can say decreases the value of your currency. Now, practically speaking, if I say that the inflation during this year is, let's say, 2%, then what will happen? I can reduce 2% out of this. 110 minus 2%, and the answer will be 107.8. So in real sense, I have earned only 7.8%. This is the real return, because out of 10%, 2% that I have earned was the contribution for the inflation itself, which is a loss to me. And nobody can avoid the inflation. And that's why the real return to you is 7.8% only. That's it. Okay. Now, one thing you need to understand that whenever there is an impact of inflation, the impact of inflation will be on the entire cash flows. That means principal as well as interest. Because inflation doesn't know like what this 10 rupees is for or what this 100 rupees is for. It will be on the entire cash flows. So this is what you need to understand. Now, how to reach at 10% with 7.8 of the real return and 2% of the inflation. So there are three things that we need to understand. This is inflation. This is real rate. And this is called as nominal rate. So if we do the calculation like this, 7.8 plus 2, it will only give you 9.8 and not 10%. Why? The reason is very simple, sir. This 2% is also applicable on the interest as well. That means this 2% should also be applicable on the interest as well. The 2% applies on the principal as well as interest. Now what you are doing here is you are applying the 2% on the principal, 7.8% also on the principal, but you are not applying the inflation on this return. Because inflation applies on all the cash flows, we need to make sure that 2% of this is also added. Now, a better way to write this is 1 plus 0.078 1 plus 0.02, that is equal to 1.10. That's called as 1 plus 0.10. Now I will tell you, see, whenever you do this thing now, 1 plus 0.02, that means you are applying this 2% on this principal and interest both. Now you do the calculation, 1.078, 1.02, you will get 1.09956, rounding off, ultimately 10%. So it will be like 1.10 is equal to 1.10. Now both are clear. So how to create a formula for this? 1 plus real rate of return into 1 plus inflation rate is equal to 1 plus nominal rate of return. This is real rate. This is inflation. And this is nominal return. So one thing is clear to you. Nominal rate includes inflation and real rate both, but real rate does not include inflation. Okay. Couple of more things you need to understand. So if the cash flows are 107.80 and if the cash flow is 110, now in order to calculate the present value in both the cases, what type of rate you are going to use? It's very simple, sir. We know that this is a real rate, or this will be called as the real cash flows. We will assume that there is no inflation included in this. This is a real cash flow. And this is a nominal cash flow. So you need to make sure one thing. Real cash flow should be discounted at real rate of return. And nominal cash flow should be discounted at nominal rate of return. Very simple. So 107.80 will be divided by 1.078 and this will be 1.10. Let me just make it clear. So this is real rate and this is nominal rate. And only then in both the cases your answer will be 100. It will be same. Today the value of 100 is 100. So sometimes they will give you the real cash flows and they will ask you to calculate the present value. So what you have to do is you need to make sure that the real cash flows are always discounted with real rate and the nominal cash flows are always discounted with nominal rate. So there are few rules that you need to follow. I will just write it down. First rule. Nominal cash flows should be discounted with nominal rate. Real cash flows should be discounted with real rate, and unless otherwise given, cash flows should be assumed to be nominal. So sometimes they will not give you the detail that if these cash flows are nominal or not. Unless otherwise given, you have to assume that the cash flows are normal, it's nominal, and use nominal rate to discount the cash flows. That's it. So these are few things that you need to understand. So, and this is the formula according to international Fisher effect. That was the theory left in the Forex chapter. International Fisher effect. This is a theory under which this concept is explained. The relation between the inflation and the real rate is this. Understood the concept of this? So inflation is applied both on the return of 7.8% and the principal of 100% as well. So that's why it is multiplied like this, 1 plus IR. This is wrong. 7.8 plus 2, real rate plus inflation rate is equal to nominal. No sir, this is wrong. It should be multiplied to the principal and interest both. So considering these two things that we have learned, one is the home currency approach, foreign currency approach, and the another one is real rate and nominal rate. We are going to solve some questions. Let's have a look on this. This is question number 5 in front of you. Let's read this. ABC Limited is considering a project in US which will involve an initial investment of 1 crore 10 lakh dollars. The project will have a 5 years of life and the current spot rate is 48. See, this is the current spot rate. Okay. The risk-free rate in US is 8% and the same in India is 12%. US 8%, India 12%. Cash inflow from the project are as follows. For the next 5 years, you are going to receive this. Calculate the NPV of the project using foreign currency approach. It means we have to discount the foreign currency cash flows. The next column should be foreign country discount rate, present value. Present value factor at foreign country discount rate. Okay. Then you will calculate the present value in terms of dollars. So it will be foreign currency approach, and then the NPV will be in dollars converted at the spot rate, and then you can calculate NPV in rupees at the end. So approach has to be foreign currency discounting. If cost of equity and debt of ABC Limited, now ABC Limited is in India, right? ABC Limited is in India and they are considering to invest in US. Okay. So if the cost of equity is 15% and 10% respectively and the debt equity ratio is 1:4, how will you calculate the foreign country discount rate? there are few things that you need to understand. First of all, you need to calculate the home country discount rate. Because if ABC Limited is in India, they might have issued equity and debt in India, and that's why the 15 and 10% rates applies to India, Indian cash flows. And the weight of these is given here. So we will calculate the weighted average cost of capital. See, first let us calculate the required rate of return on this project. Just a second. So 15% into 4 by 5, total weight is 5, right? 1:4 means total weight is 5. Debt is 1 by 5, equity is 4 by 5. So equity, cost of equity into weight of equity plus cost of debt into weight of debt. One more thing that you need to apply here is 1 minus tax after the cost of debt, but there is no data related to taxation is given. So that's why we have not applied it. It's like weight of equity. It should be like this, cost of equity into weight of equity plus cost of debt in bracket 1 minus tax into weight of debt. Since tax is not given, we have not applied it. Okay, so this is the weighted average cost of capital, but this is home country discount rate. If they would have asked us to calculate the NPV using using home currency approach now, then we would have discounted all the rupee cash flows at 14%. This is home country discount rate because 15% of the equity and 10% of the debt belongs to India. That means Indian rate. And that's why the 14% is also Indian rate. But what we are going to do now, we are going to, this will be considered as nominal rate. Okay. So we have the nominal rate of India, 14%. We have the risk-free rate of India. We can calculate the risk premium. We can take out the risk out of 14% because 12% is to risk free. Rest of the percentage will be risky. That includes risk. That is called as risk premium. And after calculating the risk premium from this, we can apply the same with the risk free rate of return of US to calculate the nominal rate of return. See what they have done now. We shall calculate the risk adjusted dollar rate first. So like this is Indian rate, or let me do it here step by step. So first for India, see what we are doing. 1 plus real rate or risk free rate into 1 plus risk premium. In case of inflation, we are going to use this is equal to 1 plus nominal rate. Understood? Now this is 1.12, 12% for India. This is what we have to calculate, and 14% is the 1.14. See, out of 14%, 12% is risk free. That means the balance will be the risk premium. Okay, so 1 plus risk premium comes to 1.01786 or 1786. So this is, you can say 1.786% is the risk premium. Now you are going to use this risk premium in US. Apply the same formula again. 1 plus risk free rate of return, 1 plus risk premium is equal to 1 plus nominal rate. Now you are going to use this risk premium here. The risk free rate of US is 8%, right? So 1.08 in bracket 1.01786. Do you get that? Now we can calculate the 1 plus nominal rate of America, US. So that will come to 9.93%. So the nominal rate of America comes to 9.93%. This is in US. This is what you are going to use for foreign country discount rate. You extracted the risk premium from Indian rate and applied it on the US rate. And that's how you have calculated the nominal rate for the foreign currency, 9.93%. This is what you need to understand in this question. And this 9.93% will be taken over here, calculate the present values, and then multiply it to calculate the present value. See, you calculated this risk premium and then you used this risk premium here with risk-free rate of US to ultimately arrive at this 9.93% is the answer, but rounding off is the issue. 1.0179 and we have taken 1.01786, and that's why a little difference is there. Now what you can do is very simple, sir. Take the foreign currency cash flows, take the discounting rate at the foreign country discount rate. See, foreign country discount rate, and then present value. You have calculated all the present value in terms of dollar. Investment was also in terms of dollar, so this NPV is also in terms of dollar. So since this is a present value, this can be multiplied with the spot rate, and then we can calculate ultimately in terms of rupees. So there are two rates in this question: home country discount rate, foreign country discount rate. So you need to make sure that 14% of that rate was applicable on home currency approach and this 9.9% on foreign currency approach. In this case, rupee cash flow should be discounted at 14%. In this case, dollar cash flow should be discounted at 9.9%. Ultimately, you can calculate the present value like this. Now, let's have a look on one more question like this. Similar question. X Limited, an Indian company, is considering a proposal to make an investment of USD 1 crore 65 lakh in Latin America. The project will have a life of 5 years, exactly same. The current spot exchange rate is 72. All investment revenues will occur in dollars, and the USD and INR risk-free rate is 8 and 12%. The rates are also same. 12%. Following cash flow is expected for the next 5 years. You can see cash inflows are $1. In this question, they have already given you 14% as the required rate of return on the project. Now this is very confusing to most of the students, since we are saying that required rate of return on the project is 14%, directly discount the cash flows with 14%. No sir, the required return is to an Indian company. So I will assume this as home country discount rate. Out of the two, I will assume it as home country rate because the return required to is an Indian company, which is 14%. So 14% will be home country discount rate. Now what you have to do is, again you have to extract the risk premium, taking risk-free rate of 12%, 14 and 12%. Right, the difference will be something like 1.779%. Apply that with the risk-free rate of America, and you will get the nominal rate of nominal rate of US. And if you have to discount the cash flows using foreign currency approach, then use the nominal rate of US. See, the viability of the project using foreign currency approach. See, this is 1.0179. Again, the rate is 9.99%. 9%. Now, again, you did the same calculation, so I am not repeating this again. See, so all the cash flows that you have taken, calculated the present value using. What has happened? Just a second. See. So you have taken these cash flows, 9.9%, again the same rate, same discounting rate, present value of cash inflow in dollars, outflow in dollars, NPV in dollars, and then multiplied it with the spot rate. Till this point, everything is exactly as the previous question. Then what is the purpose of considering this question? It is the second part. Read it. What will be the impact if there is a withholding tax of 10% applicable on the project? It means whatever the inflows are 18.02, before transferring those dollars in India, there will be a 10% tax that you will have to pay on that. And balance will be carried forward, can be repatriated to India. Have a look. This is 18.02. Till this point, the cash flows are same. And 10% will be deducted as TDS, tax deducted at source. The balance has to be carried to the India, 16.218. Initial investment was same, 16.50. NPV has reduced to negative. And the rupee value after converting at spot rate is again negative. So if there is a withholding tax of 10%, NPV is coming to negative. And that's why we should not accept this project. Otherwise, the project was acceptable, like 109.44 million was a good amount. Almost we can say 10 crore, 90 lakhs, 1 crore, 10 crore, yeah. 10 and 11 crore, almost 11 crore. But because of that 10% deduction, all the profits has been vanished. And the NPV is going to negative 20 million. That's almost 2 crore rupees. So project is not acceptable. How to do the treatment, how to apply the treatment of withholding tax, sir? Please understand that withholding tax is applied on the repatriation of cash flows, or when we transfer the cash flow from one country to another country. The profits, not the investment. Obviously, TDS will not be applicable on the investment. It will be applicable on the profits that you are bringing back to the country, India. And that's when you will have to pay 10% additional tax, and present value will be this, deduction 16.5, and you have a negative cash flow. So that's what the question was. Now let's have a look on another question, that is question number 7. DD Limited is a company based in India, manufactures good quality of leather bags and sells to retail outlets in India and USA. So sales are in the form of Indian currency and USA means dollar as well. Okay. The cost of quality leather in India is very high. The company is reviewing the proposal of importing of leather in bulk from USA supplier itself. Right now, what are we doing? We are buying the leather from India, preparing the bags, selling it in India as well as USA. But since the cost of quality leather in India is very high, we are thinking of importing the raw material also from USA. Okay. The estimate of the net dollar and Indian currency cash flows in nominal terms, they have clearly written in nominal terms, for this proposal is given below. So everything is in lakhs. Year 0, 1, 2, 3, like to start with, there will be some kind of investment. So in America, there is an investment of $25 lakh, and after that you are earning 5 lakh, 7 lakh and 8 lakh dollars. In rupees, in India, there is a direct earning of 60, 80 and 90 lakhs, since we might be present in India since years. If not imported, if we do not import the leather, then we are going to purchase it in India, and the cost of the leather will be 400 lakh, 450 lakhs, 500 lakh and 600 lakh in total. Okay, sir. Now, other information are as follows. DD Limited evaluates all investment by using a discount rate of 9%. So I'm assuming this as a nominal rate unless something else is given in the question. All US customers are invoiced in dollars and US dollar cash flows are converted into rupee at the forward rate and discounted at Indian rate. Now tell me, which type of approach is this? They have not mentioned whether to use the home currency approach or foreign currency approach. But tell me, in which type of approach you convert the foreign currency to home currency and then discount it at home country discount rate? It is the home currency approach. So this is another way of asking you to solve the question in home currency approach. Okay. The good part is, I think rates are already given to you in the question. The current exchange rate is 74. You are required to calculate. Inflation is also given in India and USA. So this will be RF and this will be RD. Inflation IDIF. You are required to calculate the NPV and recommend the decision. Present value factor using this 9% R is like this. Calculation to be made up to 2 decimal. Now, first of all, in order to calculate, see, you need the exchange rate at every point 0, 1, 2, 3. We have the spot rate for 0, but we need the exchange rate at the end of year 1, 2 and 3. How to calculate that? Using purchasing power parity theory. Because inflations are given to us and question has clearly mentioned that we have to use home currency approach. It can only be used when you can convert all the cash flows in rupees. So first we are going to use the purchasing power parity theory. Purchasing power parity theory. It is nothing but 1 plus ID 1 plus IF is equal to F by S. The inflation rate in India is 8%. So it will be 1.08, 1.09 is equal to forward divided by the spot rate is 74. See, 74 into 1.08 by 09. So you will get the forward rate for first year. That forward rate will become the spot rate for second year. And then this forward rate will become the spot rate for third year. There is another way also. You can keep 74 in all the cases. See, I will just write down the other type or other approach of calculating the forward rates. It will be like this: 74 into 1.08 by 1.09 is equal to 73.32. The first one will be same. The second one will be like this: 1.08 square 1.09 square is equal to 72.65, and 74 into 1.08 cube 1.09 cube is equal to 71.98. Now understand why square and cubes are taken, because we need the second year end forward rate and we are taking the spot rate of 0th time. So the gap between the rate that we have taken as spot and the rate that we are calculating is 2 years. That's why I have taken 2 to the power. Now what happened in this case is, we are already taking 73.32. That means 1 year has already been covered. Now the gap between this 73.32 and the rate that we are calculating is only 1 year. That's why 1. So this is another method of calculating. Now you have calculated the exchange rate. At every point, first convert the dollar into rupees. See, cash flows. This is now easy. Cash flows in dollar. Okay. This is the forward rate that you have calculated. Immediately you will multiply it with the dollar, will be multiplied with this, and you can get the dollar cash flows in lakhs. So this is the dollar cash flows converted in lakhs. Then we are going to deduct the cost of leather out of that and add the cash flows in lakhs. You can keep this row above this as well. So sales from dollar currency, sales from rupee currency, less purchases of leather in India, and this is going to be the total cash flow. Okay, so this is sales, this is purchase, and this is again sales. Okay, you can present it as per your term. All of them are in rupees now. So this is total cash flow discounted at the present value factor and the present value in lakhs, and this is the NPV, which is negative 2,146 lakhs negative. Proposal should not be accepted as the NPV is negative. So this part is very easy. The only thing that we took this question is this forward rate, home currency approach. There will be more questions on the home currency approach. Let's have a look. DK Limited is considering an investment proposal in Sri Lanka. Understand the concept. Now we want to invest in Sri Lanka, involving an initial investment of Sri Lankan rupees LKR 25 billion. The current spot exchange rate is Indian rupees per Lankan rupees is 0.37. The risk-free rate in India is 6% and the same in Sri Lanka is 5.02%. Project will generate a cash flow of LKR 5 billion in first year. The cash flow will increase by LKR 1 billion each year for the next 4 years. So 5 plus 6, 7, 8, 9. Right? The project will wind up on completion of 5 years with no salvage value. Okay, sir. See, if we have to understand, okay, let's read the question first. The required rate of return on the project is 8%. This will be home country discount rate. Simply because we are from India. You are required to find out the investment worth of the project by home currency approach and foreign currency approach. See, they have not given you, just a second. Yeah, they have given you this information of investment, whether it is worth to invest 25 billion Lankan rupees for this project. So you have to use the home currency approach. Now what will you do for the home currency approach, sir? First you will have to calculate using the interest rate parity theory in this question, not purchasing power parity theory, although the formula are same for both. You will use the interest rate parity theory, and make sure that while using the interest rate parity theory, the quotations are direct or indirect. This quote is a direct quote. This quote is a direct quote, and hence 1 plus RD by 1 plus RF is equal to F by S. If it would have been indirect quote, then the formula would be RF by RD, right? You remember that? Okay. The rates of both the countries are 6% and 5.02%. Spot rate is also given as 0.37. Now you can carry forward to calculate the exchange rate or the forward rate at every year end. And this is required for the purpose of home currency approach. See, Indian rate is 6%, Sri Lankan rate is 5.2%, so 0.37. You are calculating exactly like the previous question, and then you can use it here. You can take 0.37 also in all the years, but then it will be square, cube, 4, 5 like this. So this is also good. Whatever you like, you can do it. Okay. Now, so with this you will get the spot rate, or we can say forward rate, at every year end. This is what you are going to use to convert the Lankan rupees into Indian rupees. See. So this is year 1, 2, 3, 4, 5. This is Lankan rupees 5, 6, 7, 8, 9. Every year we are increasing 1 billion. Now this is the exchange rate. Once you have converted that into rupees, you will use the rupee discount rate. That is the return that we want, home country discount rate for home currency cash flows. Now the cash flows are in rupees. Use the home country discount rate and you can calculate the present value. There was some mistake in the question. I will tell you. Just understand, have a look on this present value. It is 0.73503 and in question it was 75503. So that was a mistake by the institute itself, and lots of people used that rate. And if you use that rate, the answer will be slightly different, and for which the institute has given the note. Don't worry about it. So rest of the procedure is same. So this is how the present value will be calculated using home currency discounted at home country discount rate. This is the present value. Now please understand, since you are investing 25 billion Lankan rupees today, so today's rate will be taken to convert the investment in Indian rupees. That is 9.2. So this is inflow, cash inflow, present value of cash inflow. This is cash outflow, and NPV. NPV is positive. You can accept the project. Okay, sir. This is the all home currency. What would you have done if foreign currency approach is asked? You will have to calculate the foreign country discount rate first. How to do that, sir? Foreign country discount rate. It's very simple. Have a look. Again, you are going to use the same method that we used in the first question, like 5th and 6th question. 6% is Indian rate, 8% is Indian rate. So this is for India. With the help of this, you have calculated the risk premium, and this risk premium will be applied for Sri Lanka. with their risk-free rate. Simple. And you will get the 7% as foreign country discount rate. Use that. So cash flows in Lankan rupees and the discount rate in Lankan currency, 7%. Present value, this will be in Lankan rupees. Investment was already in Lankan rupees. NPV is in Lankan rupees, and then you can convert that at spot rate into Indian rupees. Again, this is positive, you can accept the project. One thing you need to make sure, it's very easy to follow home currency and foreign currency approach, but you need to make sure one thing. Home currency cash flows should be discounted with home country discount rate. Foreign currency cash flows should be discounted with foreign country discount rate. That's it. The required return given in the project is normally from the home currency itself, that is home country discount rate. You will have to calculate foreign country discount rate by extracting the risk premium from this. I will also explain this like this, risk premium. If it is not given in the question, then you can extract the risk premium out of this rate and apply for the foreign currency to calculate foreign country discount rate. Both the approaches has been summarized in this short para. Home currency cash flows, home country discount rate. Till now in all the question you have seen this approach. Okay. Now question number 9 again. We are going to follow home currency approach in this. It's pretty easy question again. XYZ Limited is engaged in retail business in India. It is contemplating for expansion into a country of Africa by acquiring a group of stores having the same line of operation as that of India. The exchange rate for the currency of the proposed African country is extremely volatile. Rate of inflation is present at 40% a year. That is inflation rate in foreign currency. So IF. And in India it is 10%, so this is ID. Management of XY Limited expects these rates are likely to continue for the foreseeable future. Estimated projected cash flows in real terms. Now understand, these are in real cash flows. How are you going to convert the real cash flows to nominal cash flows? Very simple. Add inflation in that. See. If 107.8 is given, how to convert this into 110? That's what we have learned in the concept, right? You have to add the inflation in that, 2%. That's it. Add 2% in that and you will get 110%. So inflation has to be added. Okay? So add inflation or multiply it with 1.02, one and the same thing. In India as well as African country for the first 3 years of the project are as follows. Cash flows in India in real sense. Cash flows in African rands in real sense. So all the cash flows are real cash flows. Okay. If you want to discount these cash flows, then you will have to use the real rate. Okay. If the nominal rate is to be used, then first you have to convert these cash flows into nominal cash flows. XY Limited assumes the 3-year nominal cash flows will continue to be earned each year indefinitely. Now this is one additional thing that is given to you. This is perpetuity. So what is happening in this question, I will tell you. You have been given with the 3 years cash flows. Okay. You have been given with the 3 years cash flows, and then they said that the nominal cash flows of the third year, which is not given, we have to calculate that, will continue perpetually. What does that mean? That means we have to calculate the perpetuity value as well. Okay. It evaluates all investment using nominal cash flows and nominal discounting rate. It means that we have to convert the real cash flows in nominal cash flows. And it's very simple, sir. Add the inflation in that, 40% and 10%. And you will get the nominal cash flows. You are required to calculate the net present value of the project proposed investment considering the following. NPV, you have to calculate the NPV here. It will be the total of 0, 1, 2, 3 and perpetuity. You have to calculate the perpetuity value at this point. Remember the chapter security valuation? How to calculate the perpetuity at the end of year 3? You will have to take the cash flows at the end of year 4, cost of equity minus growth. Remember this? Obviously, there will not be a growth in this question. So, put 0 there. Okay. So, the present value of 0th, 1, 2nd, 3rd and the perpetuity will be NPV. Now, see, African rand cash flows are converted into rupees and discounted at a risk adjusted rate. What does this mean? Converted into rupees. It means home currency approach is being asked to use, to follow. All the cash flows should be discounted at a rate of 20%, which reflects the high risk. It means the risk premium is included in that. This is home country discount rate and nominal rate. In fact, this is not a real rate. How come nominal rate? Because the risk premium is included in that. Ignore taxation. Discounting rate at 20% is also given to us. Now understand the procedure. Take the Indian cash flows, add inflation in that, and then convert it into nominal cash flows. Take the African cash flows, add inflation in that, convert it into African cash flows. See, before looking at the answer, write down India here. I'm just writing a format. So this is real cash flow. Take the inflation index, convert it into nominal cash flows. This will be in rupees. Take Africa. This is real cash flows. 0, 1, 2, 3, right? Inflation index at 40% and nominal cash flows. But this is in African rand, right? Now, one more thing that you have to do, because we have to follow foreign home currency approach, we have to convert these nominal cash flows into rupees. So, it should be nominal cash flows in rupees. How to do that? It's very simple, sir. You have to calculate the forward rate at all point using purchasing power parity theory, because inflation rates are given. Okay, we will do that. So now this is also in rupees, Indian cash flow. This is also in rupees, African cash flow. Okay. What you will do is total cash flows in terms of rupees. Now these are in rupees. Take the present value factor at 20% and then calculate the present value. This will only be the present value of 1 to 3 year. There is one more left, which is called as perpetuity. We will calculate that later on. But now the main point is, first of all, inflation index. Now let me tell you, the inflation for 0th point is 1. For the second year will be 1.1. For the first year will be 1.1. For the second year will be 1.21. Third year will be 1.331. 1.1, 1.1 square, 1.1 cube. Because, understand, all the real cash flows are given for 0th time. Real cash flows for 0, 1 year, 2 year, 3 year. All of them are given at this stage. Okay. You have to bring it to their respective stages. I will show you. Let's take, for example, 50,000, 1,500 and 2,000, 2,500. So it's like 50,000, 1,500, 2,000 and 2,500. Now understand, inflation is 10% every year. If this is the cash flow for second year, right? So you want to first bring it to first year end, then again second year end. So 2 times the inflation will be applicable on this. Since these are real cash flows, that means not even a single inflation is included in that, and that's why it is standing at a point 0. And this is the cash flow for second year. If you want to take it to second year, the inflation for 2 years will be applicable. In this case, 3 years inflation will be applicable. So it will be like in this case 1.1 into 1.1. That means 1.1 square, that is 1.21. In this manner, we have to solve this question. Have a look. Now on the answer. See. 1.1, 1.21, 1.331. And if you take 40%, it's 1.4096 and 2.744. I will just write down. This is 1.1 square, this is 1.1 cube, this is like 1.4 square, and this is 1.4 cube. So these are the indexes: inflation factor and exchange rate as per IRPT. Now it should be as per PPP, purchasing power parity theory, because inflation rates are given. Na? What is the spot rate? See, there is one more problem in this question. The present exchange rate is African Rand 6 to rupees 1. This quotation is indirect quote. And if the quote is indirect, you need to be very careful while using the purchasing power parity theory. The formula for indirect quote will be 1 plus IF 1 plus ID is equal to F by S. S is 6 African Rand for 1 rupee. Put 1.40 in the numerator, 1.10 in the denominator, multiplied by 6. So you can do it like this. I will show you. 6 into 1.40 divided by 1.10. 6 into 1.96, because this considers like 2 years. 6 into 1.96 divided by 1.21. 6 into 2.744 divided by 1.331. And these will be the forward rates. Okay. After that, these are in rupees. Cash flows, real cash flows. Multiply this 15 with 1.10, you will get 1650. Nominal cash flows. I will just make sure to mark A, B, C, D, E, F, G, H, I, J, K, L. Okay. M. Now, how did we calculate nominal cash flows? It's sir E multiplied by A. Simple. Inflation index multiplied by the real cash flows. Now, African Rand, real cash flows, and then nominal cash flows. So H multiplied by B. Just have a look. H is real cash flows and B is inflation factor of Africa. So we have converted that in nominal cash flows. Now, in Indian rupees, how to do that? I divided by the forward rate, that is C. I means the nominal cash flows in African Rand, and divided by C. C is the exchange rate. So you have converted that in Indian rupees. Now, this nominal cash flows of Indian rupees and nominal cash flows of Indian rupees, total it, you will get the present value and then the present value. This is the present value factor and then the present value. You can clearly see that the total of the present value is negative 59,320. And the question clearly specifies that the nominal cash flow for the third year, see, for the third year will continue forever. So, how to calculate the perpetuity at the end of year 3? It will be cash flow at the end of year 4 divided by cost of capital or discounting rate, which is 20%. There is no growth, so growth will be 0. So, what is the cash flow? 16,637 divided by 0.20. 16,637 divided by 0.20. It will be the value at the end of third year. So we have to multiply it with the discounting rate of third year to bring it to present value of 0. So this is the present value of the first 3 years cash flows. This is the present value of the third year terminal value or perpetuity. So I can write it like this. Present value at the end of 0 is equal to terminal value at the end of year 3 into present value factor for third year. And how to calculate the terminal value? It's a cash flow for year 4 divided by cost of equity minus growth into present value factor for third year. Growth was 0. Third year cash flow was continued for the fourth year as well, and cost of equity 20%. So this is how we calculated. All the years or the entire life of the company is covered under both the cash flows. We can total it and still we will get this negative, this positive, a negative NPV. And that's why we will reject the project. This is a very good example where you have learned lots of things. First of all, purchasing power parity theory, then how to use that in indirect quote, then in how to convert the real cash flows into nominal cash flows, and then home currency approach, then perpetuity also in this question. So lots of things that you have learned. You can mark this question as one of the important ones. The previous questions were little easy, but this is a little difficult one. Now, after this question, one more question, like similar question was asked in exam in November 15. November 15. Okay. Now, what happened in this case is it is exactly same as the previous question, but instead of one thing which was given in that question, they have directly given in this. That means there was no real cash flows. The cash flows were nominal itself. Have a look on this question. It's an easier one. A company is based in India, manufactures very high quality modern furniture and sells to a small number of retail outlets in India and Nepal. It was India and Africa in the previous question. In this it is India and Nepal, and it is facing a tough competition. Okay, I will just skip to this part. The estimated estimate of net Indian rupees and Nepali currency cash flows for this proposal is shown below. See, exactly like that. Year 0123 Nepali currency and Indian rupees. The cash flows are given in millions. Okay, and nowhere in the first sentence real word is written. That means I told you, unless otherwise given, we are going to assume them as nominal cash flows. So in this part, this is already nominal cash flows. Now, XYZ evaluates all investment by using discount rate of 9%. All Nepali currency are invoiced in Nepali currencies. Achha, customers are invoiced in Nepali currency, and these are converted into Indian rupee at a forward rate and discounted at the Indian rate. What does that mean? It means they are asking you to use the home currency approach. Inflation in Nepal and India is given to you, and the current exchange rate is also indirect in this case. The exchange rate is indirect. So while using the purchasing power parity theory, you need to make sure 1 plus IF, 1 plus ID is used. Okay. Assuming that you are the finance manager, calculate the NPV and modified internal rate of return of the proposal. We are going to talk about this only. You may use the following values for the discounting at 9%. Lots of students, what they did is they converted these cash flows by taking inflation index of 9 and 8%. Just like the previous question, because in their material they had earlier solved this question, and they thought because they were in hurry, they thought that this is the same question. Lots of students made this mistake. One word which was in the previous question there, but not in this one. So unless otherwise given, how can you assume these cash flows as real cash flows? And if these are not real cash flows, these are nominal cash flows. There is no need to convert this. The question was easier one, but we made it difficult because of the nervousness, we can say, or hurry. We were in hurry. So don't convert anything. Just calculate the forward rates with the use of inflation, convert the Nepali currency into Indian, add it with the Indian currency, use this discount rate. That's it. You will get the NPV. Okay. Great. See. So Nepali currency cash flows converted in Indian rupees. Nepali currency conversion rate and Indian rupees. Okay, these are the three rates that you have calculated from the purchasing power parity theory here. And then you are putting it Indian cash flows of Nepali cash flows in rupees, total, present value, present value. That's it, simple. End of the story. No perpetuity in this case as well. No perpetuity. So ultimately the cash flows are this. Please understand. 15.625 and all this. Now the question is asking you to calculate the modified internal rate of return. What do you mean by, sir, modified internal rate of return? I will show you. So let me take the total cash flows 15.625. $4.479 6.53 and 7.09. 6.53, 7.09. So these are the net cash flows to you. Modified internal rate of return. Before that, you need to understand what is internal rate of return. Internal rate of return is a rate of return where you discount, you discount all these cash flows to present value and adjust it with the outflow, and the NPV should be 0. At whatever rate the NPV is coming to 0, that means you are earning exactly that much of the rate. So let's say, for example, I discount these cash flows at 12%, and if the NPV is coming to 0, and IRR will be 12%. IRR is something where the net present value is 0. But modified IRR, what you do in the modified IRR is you do not calculate the present value, but you calculate the future value. Now I will tell you how. What happens in case of modified IRR? I will just duplicate this and you have a look on this. What I am going to do, I am going to take this cash flow. The moment I will receive the cash flow at the end of year 1, I will immediately invest it for 2 years. Why 2 years only? Because only 2 years are left for the we can say maturity or the end of the entire period. I will also invest this cash flow for 1 year. There is no need to invest 7.09, right? Because it is already at the end of 3 years. Now, at what rate we are going to invest? At the discounting rate that we have used, which is 9%. Okay. So we are going to invest it at 9%. So understand, this cash flow will be invested for 2 years, 1.09 into 1.09, and this will be only invested for 1 year. So let's calculate. 6.53 into 1.09 will give you 7.12 and 4.479 into 1.09 into 1.09 will give you 5.32. Now all these, forget about these cash flows, because you have received these at year end 1 and you invested it back. So net cash flow now is 0 at the end of year 1 and 2. Now you do the total of this, all these 3 cash flows. 7.09 plus 7.12 plus 5.32. So that's 19.53. What is modified internal rate of return? I will show you. Now there should be only 2 cash flows. One at the beginning, which is 15.625, and one at the end. That's it. What happens in the modified internal rate of return? Except for the cash outflow at the beginning, you take all the other cash flows till the expiry or maturity or end of the period. And then you will find out one rate, 1 plus r to the power t. In between these 2 cash flows, what is the exact rate at which 15.625 will become 19.53? This is simple. Compound amount, this is principal amount. You calculate that rate, and this rate is called as modified internal rate of return. This is also the rate that you are earning on 15.625 to make it to 19.53. Simple. So what will be the formula? Compound amount is equal to principal 1 plus r to the power t. So compound amount will be 19.53. Principal invested is 15.625. 1 plus r to the power 3 years, right? So 19.53 divided by 15.625. When you take 3 on this side, it will be cube root and 1 plus r. That's it. So 19.53 divided by 15.625, that comes to 1.25 to the power 1 by 3, 1 plus r. Now you need to find out that rate. When you calculate, the cube of that should become 1.25. Okay, so 1.25, 12 times square root, minus 1 divided by 3 plus 1, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 1.0772. Yeah, exactly. So 1 plus R, and R will be 7.72%. This is your modified rate. How did I calculate 1.25 to the power 1 by 3? It's very simple, sir. Keep 1.25 on the calculator, press square root button 12 times, then press minus, then divided by 3, because it is in the divided 1 by 3, na? That's why divided. Plus 1 and into equal to 12 times. That's it. You will get 7.72. Let's have a look on the final answer, 7.72 cube root. So logic of this you might get confused with this formula. Oh, what is this formula? Terminal cash flow, initial outlay, cube root and all. It's very simple. Compound amount is equal to principal in bracket 1 plus R to the power T. This is, so you know, na, from time value of money. It's the same thing, man. 3 is there because there are only 3 years. You got it? So what you did is you brought this cash flow to this point, this to this point, and there are only two cash flows left at the end, 15.625 at the beginning, 19.53 at the end. And now you are thinking from the angle that at what is the rate which will make 15.625 to 19.53 in 3 years, and that's your modified internal rate of return. What is the definition of modified internal rate of return? A rate of return which will make the principal value equals to compound amount in the given time frame. This is nothing but the compound amount, this R in the time value of money. Is that difficult? No, it's not difficult. Okay, sir, with this we will end our discussion on the previous question. Every question had something, although small, but to learn. So we could not skip, although I wanted to give some questions as homework, but we could not skip a single question. This question had this modified internal rate of return concept. This question had a lot of concepts: PPP, indirect quote, real cash flows to nominal cash flows, perpetuity, home currency approach. In the previous question, we used both the approaches, home currency and foreign currency. Before that, we used, I think that was the normal question. Yeah. Before that, we used this withholding tax, foreign currency approaches. I hope it is very clear to you now. Now is the time to move on to question number 11. Let's start with question number 11. A proposed foreign investment involves creation of a plant with an annual output of 1 million units. How much we are going to produce? 1 million unit. The entire production will be exported at a selling price of $10 per unit. Understand? Total production will be 1 million and every unit will be sold at a $10 per unit. Okay, so the total revenue will be 10 millions. Am I right? Okay. At the current rate of exchange, the dollar cost of local production equals to $6 per unit. So can I say $10 is the selling price, $6 is the variable cost, and $4 will be your contribution. Dollar is expected to decline by 10% or 15%. The change in the local cost of production and probability from the expected current level will be as follows. See, the exchange rate is expected to, the dollar rate is expected to decline by 10 or 15%. Okay, it's not 10 to 15%, it's 10 or 15% to be very specific. And if the dollar declines, this exchange rate, this variable cost of $6 will also decline. And that is given in this table. Understand, if there is no decline in the dollar value, there will be no reduction in the local cost, and the chances of this is 40%. If the dollar value declines by 10%, the reduction in the local cost will be $0.30 per unit. That means it will come down from $6 to $5.70. Am I right? And the chances of this is 40%. If dollar declines by 15%, either it will be 0%, 10 or 15%. 0.15 additional reduction will be there. That means in total it will be reduced by 0.45. 0.30 plus 0.15 additional. So it will be 5.55 USD. Now This is the variable cost. But in all the three cases, the selling price will remain same. ठीक है? Okay. And the chances of this is 20%. Cool. The plant at the current rate of exchange will have a depreciation of USD 1 million annually. Since it is a depreciation, please understand, if the dollar value declines by 10%, this existing value will become 9 lakhs. 10% less, 10 lakh minus 10%. And if it declines by 15%, it will become 8 lakh 50,000. It is a depreciation, it's not a cash flow. It's not a cash flow, it's just a depreciation. So you can directly deduct that value. Okay, because they are saying at the current rate of exchange it is 1 million. If the dollar is going to decline, the depreciation value will also decline. It's not a cash flow. Okay, assume the local tax rate at 30% as 30%. Annual cash flow after tax under all the different scenarios of exchange rate. There are three different scenarios: no change, 10% decline, and 15% decline. In all the cases, the revenue will remain same, 10 million, 10 million, 10 million. But the production cost will reduce, 6 million, 5.7, 5.5. And the depreciation will also. Apart from this, there is no other cost. So what will happen? It's very simple. Sales minus variable cost, this is contribution, minus fixed cost, this is profit before tax, minus tax, this is profit after tax. And they are asking you to calculate cash flow after tax, not the profit after tax. So add back depreciation. Do you know this procedure? When you add the depreciation, the non-cash item in the profit, you will arrive at cash flow after tax. That's the same procedure. Have a look. Scenario 1, 2 and 3, 0%, 10% decline and 15% decline. Okay, you can see the sales are same in all the cases. Selling price per unit, annual sales, right? Cost per unit, profit per unit. See, cost 6 to 5.70 and 5.55. So this is profit, means contribution. Then this is the total profit. When you multiply the number of unit with the contribution per unit, this is the total contribution. Minus depreciation, 10 lakhs minus 9 lakh, and 10, 9 and 8.5. If 10% is the decline, it will become 9. Then profit before tax, less tax of 30% on the PBT. Profit after tax, add back the same depreciation that you deducted in order to arrive at the cash flow after tax. It's very easy, not that difficult. Okay. Then the second part is expected value of the CFAT assuming no repatriation of profit. What is the expected value? These three are the probabilities. These three are the probabilities: 0.4, 0.4, 0.2. Multiply these cash flow after tax with the probability and then do the total. This is the expected value of the CFAT. Cool. Have a look. That's very easy, man. See, this multiplied by probability and this multiplied by probability. So the expected value of the cash flow after tax is 32,26,000. Now the last part of this question. Viability of the investment. That means we have to calculate NPV. Viability means whether we should invest or not. If the initial investment in this is 25 million on plant and working capital with a required return of 11%, this will become cost of equity. And on the basis of CFAT arrived under option 2, means just before this expected cash flow after tax will continue to grow at 3% per annum in perpetuity. So do you understand what kind of formula will be required here? It's very simple, sir. You have to calculate the value of perpetuity and it will be like this: P0 is equal to CFAT 1, that means CFAT 1 plus growth divided by cost of equity minus growth. Growth rate is given to you, 11% is the cost of equity. The cash flow after tax that you have arrived at in second option will be taken over here at 3% growth rate. So this is the value of the perpetuity. This price plus this price. Okay, so this is the total value. That's it. It's very simple, sir. Just have a look now. See, this is the expected CFAT taken from this. It will grow by 3%. So you can see we have a growth rate here. This is the cost of equity and this is the growth rate. It's easy. So CFAT 1, or we can say CFAT 0 in bracket 1 plus growth divided by cost of equity minus growth. and the total value, the perpetuity value, which include all the cash flows, is included here. That is 4.15. We can say 441.53 millions. So this is the cash inflow to you, and this includes, this is at zero time itself. Zero time itself. That means we are not going to add any further 30 to 26 CFAT. This is included in that 415. So value of the inflows is 415. 25 million is your outflow as given in the question. NPV of the project. Project is viable. Positive NPV. That's it. I think that was the easiest question till now. So question number 12 is going to be the next question, where we are going to learn one new concept. Till now we have solved questions where we have calculated net present value, but what about adjusted net present value? If you look at this, this is where we are going to calculate adjusted net present value. Have a look on this question.